For most of civilized history, money was gold or a claim on gold. This was not primitive superstition, it was economic selection. Gold satisfied objective criteria: durability, divisibility, portability, fungibility, scarcity, and a high stock-to-flow ratio. It was costly to produce and impossible to print at will. Gold-backed currency represented a claim on something real. Yes, such a system required banks, vaults, courts, and governments. It required enforcement and trust, but that trust was limited. Under a gold standard, issuers could not create unlimited claims without consequence. Redemption imposed discipline. If institutions overissued, they lost gold. The constraint was physical, not political. Fiat currency removed that constraint. Modern fiat money is backed by government debt, taxation authority, and central bank policy. In practice, it is backed by political discretion. There is no hard limit to issuance beyond institutional restraint. The anchor is no longer scarcity in nature, but promises in policy. History shows how fragile that restraint can be. Governments face constant pressure to finance wars, welfare states, bailouts, and deficits. Inflation becomes the hidden tax. Fiat depends entirely on confidence. When confidence weakens, the currency weakens with it. Cryptocurrency claims to solve this by eliminating trust. Bitcoin replaces central authority with code, fixes supply through protocol rules, and enforces scarcity via proof of work. But scarcity alone does not create value. Gold's scarcity is natural and independent of human consensus. It also has non-monetary uses in electronics, aerospace, medicine, and jewelry. Even if it ceased to be money, it would retain value. Bitcoin has no non-monetary use. Its value depends entirely on collective belief that others will accept it as money. It is reflexive. The network creates price, but price is not the same as value. Bitcoin is often described as trustless. This is misleading. It requires trust that the code remains secure, that miners continue operating, that developers do not change core rules, and that governments do not severely restrict it. Trust is not eliminated, it is displaced. More importantly, Bitcoin is not redeemable for anything external. It is not a claim on a commodity. It has no anchor outside its own protocol. This reveals the structural issue. If money is backed by something real, enforceable redemption is required. Enforceable redemption requires institutions. Institutions require trust. If money is fully trustless, it cannot be redeemable for an external asset. Without redemption, backing disappears. There is a trade-off. Eliminate institutional trust, and you eliminate tangible backing. Retain tangible backing, and you must retain institutions. The attempt to engineer trust away misunderstands the nature of money. Money is a social institution that coordinates production, contracts, and long-term exchange. Law and governance are inseparable from it. The rational solution is not to abolish institutions, but to constrain them. A properly designed gold-backed system limits government expansion, restricts inflation, and ties currency to physical scarcity. It accepts that trust is unavoidable, but it binds that trust to something objective and costly to manipulate. Fiat empowers institutions without hard constraint. Crypto removes institutions but also removes external backing. Gold alone combines objective scarcity with institutional structure. It does not pretend trust can vanish. It disciplines it. The enduring monetary question is not how to eliminate trust. It is how to anchor trust to reality. For thousands of years, gold has done exactly that.